October 10th, 2025. A message goes out to precious metals dealers across North America that should have sent shockwaves through every financial newsroom on the planet. Major silver refineries, companies that have operated continuously for decades, announced they're no longer buying silver, not reducing purchases, not slowing operations, completely stopping. And here's what nobody in the mainstream financial media is telling you about what happened next. Within 48 hours, the entire physical silver supply chain seized up like an engine without oil. Dealers who had been buying silver coins and scrap from the public for years suddenly couldn't move their inventory. Local coin shops found themselves sitting on metal they couldn't sell. Major wholesalers that had operated for decades issued statements they'd never had to issue before. We are no longer accepting silver purchases until further notice. But this wasn't just an American problem. Across the Pacific, Vietnam's largest bullion dealer, Phu Quy Group, completely stopped accepting new silver orders. Canadian dealers began limiting U.S. shipments and retreating into regional markets only. For the first time in modern history, the global arbitrage mechanisms that normally move silver between countries to balance supply and demand simply froze, and the price gap between paper silver and physical reality exploded to levels not seen since the 1980 Hunt Brothers squeeze. While financial headlines focused on silver hitting new highs around $58 per ounce, they completely missed the real story. The infrastructure that moves silver from your old jewelry drawer to industrial manufacturing just broke. And when I say broke, I don't mean slowed down or got expensive. I mean the system that has functioned for 40 years stopped working in a matter of days. Let me show you what really happened when the silver refineries froze. Why this isn't just another price spike story, and why understanding this crisis gives you a window into something much bigger than silver. Because this isn't about predicting the next $5 or $10 move in the silver price. This is about recognizing the moment when paper markets start disconnecting from physical reality. And that disconnection is happening right now. By the end of this analysis, you'll understand exactly how the silver supply chain works, why it suddenly stopped working, and what this tells us about the structural weakness in commodity markets that most people never see. This is not financial advice. This is an educational breakdown of market structure that reveals how quickly seemingly stable systems can freeze when stress hits the right pressure points. To understand why refineries stopping silver purchases created such chaos, you need to understand how the silver supply chain actually works, and it's more fragile than most people realize. Here's the normal flow. You take your old silver jewelry or coins to a local dealer. The dealer pays you immediately, usually within a few percentage points of spot silver price. That dealer then ships your silver to a refinery, where it gets melted down and converted into $9.99 fine silver bars that industrial users and investors actually want. The refinery pays the dealer, and the refined silver enters the wholesale market. But here's the critical part most people miss. Refineries don't pay dealers when the silver arrives. They pay when they receive it, using something called a refinery advance. Essentially, the refinery immediately credits the dealer's account for the silver value, then processes the material over the following weeks. This advance system allows dealers to maintain cash flow and keep buying from the public without waiting for the actual refining process to complete. This advanced system works because refineries finance these operations through something called the silver lease market. When a refinery needs short-term financing, they borrow silver from bullion banks at an interest rate called the lease rate. Under normal conditions, these lease rates run between 1% and 3% annually. The refinery borrows silver, processes customer material, then repays the borrowed silver once refined metal becomes available. The beauty of this system is its efficiency. Refineries don't need massive cash reserves to operate. Dealers get paid immediately instead of waiting weeks for processing. And the silver keeps flowing from scrap and coins into the refined bars that industry actually needs. It's a well-oiled machine that has operated reliably for decades, processing billions of ounces of silver and supporting everything from jewelry stores to industrial manufacturers. But like any leverage system, it has a critical vulnerability: the cost of short-term financing. When lease rates are low, everyone wins. Refineries can afford to advance payment, dealers can maintain inventory turnover, and silver flows smoothly through the supply chain. But when those rates spike dramatically, the entire mechanism breaks down. Now here's what changes everything. In early October 2025, silver lease rates didn't just rise, they exploded. According to industry sources, rates that had been running at 12% jumped to over 100% in a matter of days. Some reports put peak lease rates at 110%. Think about what that means. If you're a refinery and the cost of borrowing silver for a few weeks suddenly becomes 100% annually, your entire business model breaks down overnight. The numbers tell the story of a system under unprecedented stress, and when you stack these data points together, the picture becomes unmistakable. First, the lease rate explosion. According to SD Bullion's leadership, the Royal Canadian Mint, which normally ignores lease rates in its cost models because they're typically so low, saw rates jump from 12% to over 100%. The Royal Canadian Mint. These are government-backed institutions with massive credit facilities, and even they couldn't absorb the financing costs. Second, backwardation. For those unfamiliar with the term, backwardation occurs when the spot price of a commodity trades higher than the futures price. This is the opposite of normal market conditions, where futures trade at a premium to spot to account for storage and financing costs. In early October 2025, silver spot prices were trading nearly $3 per ounce above December futures, the steepest inversion in decades. Backwardation signals one thing: immediate physical delivery is more valuable than future promises. Third, refinery backlogs. Multiple sources report that refining backlogs stretch to 3 to 4 months or longer. North America's largest refiners issued advisories stating they were not purchasing any new silver until further notice. This wasn't a temporary slowdown, it was a complete halt. Fourth, inventory depletion. COMEX registered silver, the silver available for immediate delivery against futures contracts, fell from approximately 290 million ounces at the start of 2024 to below 210 million ounces by October 2025. That's over 80 million ounces drained from exchange inventories in less than a year. But here's the number that should terrify anyone paying attention. Dealer financing arrangements collapsed overnight. For decades, refineries advanced 90% to 95% of silver value immediately upon receipt. In October 2025, according to industry insiders, some refineries slashed advances to as low as 30% and began charging interest on the remaining balance. One dealer with 40 years in the business described it as something that hasn't happened in over 40 years. Fifth, global shipping disruptions. According to First Majestic Silver's first mint, refineries were literally trying to ship 1,000-ounce silver bars by airplane to London because London vaults didn't have available silver, and lease rates had spiked to 89%. When you're air freighting silver bars across oceans instead of using normal shipping, you know the system is under extreme stress. Sixth, exchange inventory ratios. COMEX silver futures now represent approximately 1,802% of registered silver specifically, meaning there are roughly 18 paper claims for every ounce available for delivery. When that ratio gets stressed by actual delivery demands, something has to give. Now let's map what happens when the system breaks down completely, because we're not just seeing stress, we're seeing the early stages of systemic failure. When lease rates hit 100%, refineries can't afford to advance payment to dealers. When refineries can't advance payment, dealers can't afford to buy from the public. When dealers stop buying, the physical silver that would normally flow into the system stops flowing. And when that flow stops, the gap between paper silver and physical reality starts widening. Here's the cascade effect. Industrial users who need physical silver for manufacturing suddenly find themselves competing for a shrinking pool of available metal. Solar panel manufacturers, electronics companies, medical device makers, they all need silver, and they need it in specific forms and purities. When refineries stop processing, the supply of refined silver that meets industrial specifications begins to dry up. But the crisis doesn't stop at manufacturing. When refineries can't process scrap silver efficiently, it creates a bottleneck that affects every level of the market. Jewelry stores that normally sell estate pieces find buyers offering drastically lower prices, sometimes 50% below melt value, because dealers know they can't move the material profitably. Coin collectors trying to liquidate holdings discover that what should be a simple transaction has become nearly impossible. The real fracture line appears in the price discovery mechanism itself. When physical silver becomes unavailable at posted prices, the paper market loses its connection to reality. Futures contracts promise delivery of silver that may not exist in accessible form. ETFs claim physical backing with metal that may be tied up in processing backlogs or financing arrangements that no longer function. But here's where it gets dangerous. Not in headlines, in the plumbing. The same financing stress hitting refineries affects every part of the silver ecosystem. Bullion banks that normally provide liquidity to the market face their own financing constraints. ETFs that promise physical silver backing find it harder to source metal for new share creation. Even sovereign mints face pressure. According to industry reports, some mints completed their 2025 production runs early and announced they were holding off on additional output until financing conditions stabilized. The disconnect between paper promises and physical availability becomes impossible to hide when even government mints can't afford to produce coins. This is where it gets dangerous. The system only works as long as nobody asks for delivery. But when physical shortages become obvious, when premiums explode, when delivery times stretch to months instead of weeks, confidence in paper markets starts to crack. And once confidence cracks, you get the 1980 scenario all over again. Except this time, it's not two billionaires cornering the market. It's structural shortage colliding with a leveraged paper system. The closest parallel to what we're seeing isn't the Hunt Brothers squeeze of 1980, though that's what most people reference. The real parallel is the London nickel exchange crisis of March 2022. Here's why that comparison should keep you awake at night. In March 2022, nickel prices on the London Metal Exchange spiked 250% in 2 days because a major short position couldn't source physical nickel to cover their obligations. The exchange response? They suspended trading, canceled trades retroactively, changed the rules in real time to prevent a short squeeze from destroying the market. But here's what matters. The physical shortage was real, even if the exchange could manipulate the paper price. The pattern resembles what we're seeing in silver, but with a critical difference. In nickel, it was one large short position creating the crisis. In silver, it's structural supply deficit meeting systemic financing breakdown. You can change exchange rules to protect a few large players. You can't change exchange rules to create physical metal that doesn't exist. Watch what happens when physical demand collides with paper rules. The 1980 template shows us how exchanges respond to delivery stress. They change margin requirements, impose position limits, and ultimately force cash settlement instead of physical delivery. COMEX did exactly this in 1980, and it worked because the Hunt brothers were leveraged speculators who could be forced out. But what happens when the shortage isn't speculative? What happens when industrial users genuinely need metal for production, and refineries genuinely can't source or process enough material to meet demand? The exchanges can change rules, but they can't manufacture silver out of thin air. If you understand this next point, the whole market looks different. Silver refineries stopping purchases isn't just a temporary disruption, it's a stress test of the entire paper to physical conversion mechanism. And that mechanism is failing. Now let's talk about who benefits and who gets hurt when the physical silver market freezes, because understanding the players helps you understand where this leads. The winners are obvious. Entities holding physical silver in refined form. Primary silver miners with stockpiles suddenly find their inventory worth premiums they haven't seen in decades. Companies like First Majestic Silver, Hecla Mining, and Pan American Silver, if they have refined silver on hand, benefit from a market where physical commands massive premiums over paper. Industrial users with secured supply contracts also win. Solar panel manufacturers, electronics companies, and medical device makers who negotiated long-term silver supply agreements at fixed prices can continue production while competitors scramble for metal at spot markets. This is why major industrial users are increasingly signing multi-year deals with miners and refiners instead of relying on spot markets. Bullion dealers who adapted quickly and maintained refining relationships also benefit. According to industry reports, some dealers continued operating by offering lower premiums and extending settlement times, but they captured market share from competitors who froze entirely. The losers are more interesting. Regional refineries that depended on advanced financing found themselves unable to operate. Local coin shops that built business models around quick inventory turnover suddenly couldn't move silver, forcing them to either drastically lower buy prices or stop purchasing altogether. Investors holding silver ETFs face potential problems they probably don't understand. ETFs promise physical backing, But when physical becomes scarce and lease rates explode, how do ETFs source new metal for share creation? Some Indian silver ETFs reportedly halted new investments because they couldn't source enough metal to back additional shares. But the biggest losers are anyone dependent on the paper silver market functioning normally. Industrial users without secured supply suddenly face not just higher prices, but availability questions. Small manufacturers who assumed they could always buy silver when needed find themselves competing for scarce refined material at premium prices. Here's who else gets hurt. Pension funds and institutional investors who hold silver through paper instruments without understanding the delivery mechanism. When physical becomes scarce, paper promises become worth exactly what they say. Paper. Speculative traders who built positions assuming normal market liquidity find themselves in a market where normal rules no longer apply. And perhaps most significantly, the credibility of commodity exchanges themselves comes under question. When COMEX or LBMA can't guarantee physical delivery against contracts, when exchanges have to change rules or force cash settlement, confidence in the entire price discovery system erodes. This isn't just about silver. It's about whether paper commodity markets can function when physical supplies become genuinely constrained. This is not a theory. It's a stress pattern. Regional refineries with 40 years of operating history stopped buying silver because the financing model that sustained their operations for decades broke down in 48 hours. Here's what we know for certain. The silver supply chain that has operated reliably for decades froze in October 2025. Lease rates exploded from 12% to over 100%. Major refineries stopped buying. Dealers couldn't move inventory. Physical silver became unavailable even at premium prices in many markets. This isn't about predicting a date. This is about recognizing a pattern playing out right now. The system that converts scrap silver into refined industrial inputs just demonstrated how fragile it really is. And when that system breaks, the gap between paper promises and physical reality becomes impossible to hide. The direction matters more than the exact number. Whether silver trades at 58, 68 or $78 per ounce tomorrow doesn't change the fundamental reality. The infrastructure that moves silver from mine to market is under stress, unlike anything seen in 40 years. The refinery freeze shows us something critical about modern commodity markets. They're more leveraged, more interconnected, and more fragile than they appear. When financing stress hits the right pressure points, systems that seem stable can stop functioning almost immediately. This is about recognizing a fracture line in the market structure itself. Not speculation, logistics. Not prediction, pattern recognition. If you want to understand who really controls the world's silver supply and why that control is being challenged right now, there's more to the story. Because while we've talked about the refineries freezing, we haven't talked about the institutions that have been quietly accumulating physical silver for over a decade. Positions so large they could squeeze the entire market if they chose to. Check out the next video to see who holds the stockpiles that could turn this refinery crisis into something much bigger. Understanding the freeze is one thing. Understanding who has the power to make it permanent is another level entirely.